So this time, I think we're going to get closer to the $3,000 targets that we saw hit in 1980 in the Dow Jones and the S&P 500 because it is the top derivative layers of the pyramid that will fall in purchasing power the fastest.
There is something big coming. I would urge everybody to watch my video, Markets Crash, the eerie similarities between 1929 and today. So, please wait patiently for the failure of the system. Sorry, I'm laughing. I can laugh because I'm a precious metals investor. And I know when everything else is falling, gold and silver are going to be rising, and they're not just going to be rising, they're going to be rocket-propelled.
This year has delivered a dramatic reordering of investor priorities, with gold once again playing its historic role as a store of value, while global markets wrestle with volatility and currency weakness. Yet, despite gold's resilience, it is silver that has emerged as the standout story of 2025. In September, silver broke decisively through the $40 threshold, climbing to $40.57 per ounce, a level last witnessed 14 years ago. This represents an extraordinary 45% year-to-date rally, the kind of move that not only attracts veteran precious metals traders, but also pulls in a new wave of investors eager to capture the momentum. Silver's surge has shifted market sentiment, transforming it from a supporting asset into a leading protagonist in the commodities sector. What makes silver's trajectory even more striking is the scale of its market relative to gold. With an annual valuation of around $25 billion compared to gold's vast $180 billion, silver's smaller market means it is far more sensitive to capital flows. A seemingly modest $1 billion reallocation of funds, just a fraction of global capital movements, represents about 4% of silver's annual supply, enough to spark dramatic repricing. This dynamic explains why silver often outpaces gold when investor interest intensifies, acting almost like a leveraged version of the precious metals trade. It is this structural sensitivity that gives silver its reputation as volatile, yet potentially explosive, especially during times when trust in financial assets begins to falter. According to market expert Rafi Farber, the current valuation of silver dramatically understates its true worth. He highlights that based on historical gold-to-silver ratios and broader monetary fundamentals, silver's realistic floor begins at $100 per ounce, far above where it trades today. Farber takes this thesis further by pointing to silver's historic relationship with the S&P 500 in 1980, suggesting that if such ratios were restored, silver prices could ascend toward a staggering $3,000 per ounce. This is not merely an optimistic projection, but a reflection of what can unfold during genuine monetary upheaval, when intangible paper assets lose credibility and hard, tangible commodities rise in stature. Now, we present the clips from Rafi Farber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The CRB adjusted ounce target of $118. CRB adjusted means we're going to take the silver ratio to the CRB commodity index, its lows, meaning how many ounces of silver did it cost to buy one basket of CRB commodities. The CRB commodity index is an index that's been around since the 1970s, I believe, or even earlier. I think it was interpolated earlier, but it started to get use in the 70s. The low for this ratio means the least amount of silver ounces that a CRB commodity basket was worth was, of course, in 1980 at about 8 ounces. Well, you see here where it says last 20.22. So if we go down to 7 or 8 and then we multiply that factor by the current silver price of $41, we get $118 per ounce of silver. But this is the lowest dollar amount target. I believe we're going to get much higher than that. We're going to go to the next one, which is this. CPI adjusted ounce target. If you adjust for CPI, a lot of people are fans of this one. I'm not a particularly big fan of this ratio because the CPI itself is adjusted and manipulated and doesn't make much sense and is very subjective because people buy different things. But anyway, The high here for 1980 relative to the CPI going back to 1800 or interpolated back then, which is all an estimate because nobody knows exactly what the prices really were back then. But anyway, the high was $172.54 CPI adjusted silver ounces in 1980. But that target I don't really like, and I don't think it's realistic. I think it's way too low. The Dow Jones Industrial Adjusted Ounce 2011 target for silver. So we're going to take the Dow Jones ratio to silver back at the 2011 high. This is not the 1980 high. That's a separate chart. We're going to get to that in a minute. The 2011 high was at about 250 ounces of silver for one Dow Jones Industrial unit. And we are at 1146. You can see here, this is the first bubble of stocks, major bubble relative to silver, peaked in 2001. This is the second bubble. It's been wobbly since about 2017 or 2018 top over here. And we've been heading down since then in jagged little edges. But I think this bubble has peaked in 2017 or 2018, whenever that peak happened to be. If you take the 2011 top in silver ounces, 250 ounces per Dow Jones Industrial Average unit, 1146 to 250, take that ratio, multiply it by 41, and you get a target of $188 for the 2011 silver high relative to the Dow Jones. This is much more realistic. The gold adjusted ounce target is $236. If we're talking about the 1980 high of gold to silver ratio of 15 to 1, which I go into on this channel often, in the end game, we are going to see something around a 15 to 1 ratio of gold to silver. This is the natural monetary ratio. It will reintroduce itself. We saw it in 1919, we saw it in 1968, and we saw it in 1980, and we are going to see it again. Now, if we reach the 15 to 1 gold to silver ratio, which we will at the current gold price of about $35.50 over the weekend, that leads us to about a $236 target for silver if the gold dollar ratio doesn't move, which of course it will. Here again is bubble one of stocks relative to silver. Here is bubble two. And so if we take the 2011 top at 25 ounces of silver per S&P 500 unit, we are at 162 now. We were at 25 then. Take that ratio, multiply it by 41, and you get $265 an ounce of silver if we reach the 2011 highs relative to the S&P 500. But let's go further still. And now here's where we take a quantum leap. The Dow Jones Industrial Adjusted Ounce 1980 target of $2,676 an ounce. Why is that? Well, if we look at the silver to Dow Jones Industrial ratio, remember the chart a few slides ago where we took the 2011 top. Now we're going to take the 1980 top. We're going to reverse the chart so we can see it better. The top of silver relative to the Dow Jones Industrial ratio was 57. This, of course, is the ratio times 1,000, just to give it better, easier to do math numbers with. So if we take the ratio and multiply it by 1,000, we are at 0.873 now. We were at a high of 57 back in 1980. So if you take 57 divided by 0.873 multiplied by the current silver price of $41, you get a target of $2,676. Now let's move to the final target for silver. This is the S&P adjusted ounce 1980 target is $3,006. How is that? Because the ratio of silver to the S&P 500 index is now 0.006. You can see we've had an amazing rally in 2025. You can see a tiny little bump up. Look at that. It's amazing. What a rally. Silver is really tearing people's faces off. Is that the expression? Not really. Not yet, but it will. But if we take this number and the peak here is at about 0.43, that's where the red line shows, maybe 0.44. I think it was actually 0.44. So if we take 0.44 divided by 0.006, multiply it by the current silver price of $41, we get $3,006 per ounce of silver. Now you could ask me, why do the silver to stocks ratios jump up so dramatically relative to all the other ratios? What is the deal here? I would say that 1980 was a true monetary panic. And in monetary panics, the top derivative layers of the pyramid fall the fastest. And all the purchasing power from those layers of the pyramid gets destroyed the fastest. If you have something like the CRB index, which is a collection of real commodities, or the gold to silver ratio, which gold will only go down to about 15 to 1. The Dow Jones and the S&P 500, by comparison, are a measure of derivatives, of things that are not money, that are farther away from money than, say, commodities are. And the CPI, for example, is the consumer price index, how much it costs to buy real commodities. And so those things are not going to fall in value because you need them relative to stocks, which you don't because they're just derivatives. And when derivatives fall because credit falls, their purchasing value goes down the fastest. So this time, I think we're going to get closer to the $3,000 targets that we saw hit in 1980 in the Dow Jones and the S&P 500, because it is the top derivative layers of the pyramid that will fall in purchasing power the fastest.
Market expert Mike Maloney has been sounding the alarm on what he sees as one of the most dangerous setups in modern financial history. He points out that nearly every valuation metric, from the Shiller P/E ratio to Tobin's Q and the Buffett indicator, shows the U.S. stock market at unprecedented levels of overvaluation, even higher than the peaks of 1929 and the dot-com bubble. At the same time, real estate has entered one of the largest bubbles ever recorded, with housing defaults climbing and loan delinquencies rising at levels not seen since the global financial crisis. Maloney stresses that this isn't just a single bubble waiting to burst, it's a convergence of bubbles across stocks, housing, and debt markets, all poised to correct simultaneously. In his view, this creates the conditions for one of the largest financial crashes in history, a moment when investors relying solely on traditional assets could suffer devastating losses. Against this backdrop, Maloney argues that gold and silver are not simply hedges, but essential lifeboats in an unstable system. He highlights that when overvalued markets implode, capital always seeks safety, and precious metals historically absorb that flow better than any other asset. Unlike stocks or real estate, gold and silver cannot be devalued by central bank policy or default risk, making them uniquely positioned to benefit when confidence in fiat systems collapses. Maloney believes the next downturn won't just send metals higher, it could trigger a rocket-like move as investors panic out of paper wealth and into tangible stores of value. For those who understand the lessons of history, he suggests, the coming reset may be less about fear and more about opportunity, as precious metals step into their role as the ultimate safe haven in times of systemic failure.
I won't say this, but you can take a look at the name. Market crash indicator, 30-year bond over the 2-year Treasury, August final print. This indicator, which measures the spread between the 30-year and the 2-year Treasuries, has called the biggest crashes of the last 30 years every time. And it fired off, and it just fired off this afternoon. Now, this was on August 29th. And so last Friday. So if you're a history buff, this could be the bell at the top. As you can see, this level sparked crashes in 1990, 2000, 2007, and 2020. And if history isn't your jam, well, you could very well be right. Spoiler, probably not. Indicators work until they don't. This ratio isn't a mystery to anyone of import in the market, and they may have taken steps to mitigate. Spoiler alert, they didn't. What we can all agree upon is the fact that, I'm dyslexic, is the fact that nothing in life is guaranteed aside from indigestion from drawdowns. So my best to all, wherever your portfolio sits. This addled mind, methinks the bulls are likely picking up pennies in front of a steamroller. But then again, don't take this as advice. I eat crayons. I like the way this guy writes. He's fun. But what we see here is an oscillator that this is the indicator. It's when it crosses this 50% line, and we just have crossed the RSI, and it's predicted crashes in the markets, 30-year and the 2-year, and market crash indicator. This was only a 20% decline, 50% decline, 57% decline, 34% decline. What is this one going to be? It's going to be one of the biggest in history. Hang on to your hats. We are going to keep on going with this. Everyone is max bullish on the Dow Jones 125-year resistance trend line. Fascinating psychology. So I haven't seen this before. This is really interesting, that you can just draw a trend line right across the top of the Dow rising, measured in points, and this is 25, 50. Yeah, this is logarithmic. So a couple of interesting things on this chart. Whenever it hit the line, there's the 1929 crash. The markets got way overvalued in 1966, and notice the Dow bumped its head on 1,000 points and couldn't decisively break through until 1982. So 16 years, the Dow was trapped in a sideways range. It got overvalued in 2001. It was not overvalued in 2008. This was the real estate bubble popping, and real estate dragged the stock markets down. And now we are right at the top of this trend line again. But notice these two blue lines. These are called Bollinger Bands. And when the markets are pushing the edge of the Bollinger Bands, the Bollinger Band rises, but it also falls on the other side, giving room for a correction. So whenever the Bollinger Bands are being stretched to the max in one direction, they stretch to the max in the other direction, giving room. It's showing what the potential crash could be. And you can see the market's pushing the Bollinger Bands up at, it's one bullish candle after another, green candles going up, and very few red candles. I wish they wouldn't do red and green. 8% of men are red-green color challenged. And so it makes it very difficult for them. But take a look when we hit the peak in 2001, where the Bollinger Band went here and where it went during 29 to 32. It was saying that there was a potential of crashes that are even worse. And so it's been pushed up, but it hasn't really fallen that far yet. But it will. Now, this was a stock market bubble. This was a stock market bubble of a different type, which I will show you later. This was a definite stock market bubble. This was a real estate bubble. This one, as we will see in a moment, is a stock market bubble and a real estate bubble simultaneously. And they're both going to be undergoing corrections simultaneously. And that is what has the potential to make this one of the worst crashes in history. So I just showed you that we have the most overvaluation in stocks in history ever. Higher than 1929, higher than the dot-com bubble in 2000. And now we've got the biggest real estate bubble in history. So to revisit this again, this was a stock market bubble, 1929. This was a stock market bubble, 1966 actually is the high there. This was a stock market bubble, dot-com bubble, 1999-2000. This is a stock market bubble and the biggest real estate bubble in history. It's all going on simultaneously, and it's going to correct simultaneously. So, my friend Brent Johnson of Santiago Capital, last week, or week before last, I went to dinner with him. He lives here in Puerto Rico. I've spoken with too many smart people who know system is blanked. And while they don't come out and say it, they are singularly focused on making as much as they can, as quick as they can, in order to be prepared for what comes next. And man, there is something big coming. I would urge everybody to watch my video, Markets Crash, the eerie similarities between 1929 and today. So 1929 then versus now. Please watch this thing, because I believe we may be headed for the biggest crash in history. Remember, in 1929, real estate was not in a bubble. And so please wait patiently for the failure of the system. Sorry, I'm laughing. I can laugh because I'm a precious metals investor. And I know when everything else is falling, gold and silver are going to be rising, and they're not just going to be rising, they're going to be rocket-propelled. So when the whole world is running towards a cliff, he who runs in the opposite direction appears to have lost his mind.
Silver is being hailed as the standout commodity of 2025, outshining gold with a performance that underscores its unique position as both an industrial necessity and a monetary safe haven. Surging past the $40 mark for the first time in more than a decade, silver's breakout has ignited global investor attention and sparked renewed debate about where this rally could ultimately lead. Gold, too, is advancing steadily, pressing toward new record highs, but silver's velocity has shifted sentiment, transforming it from a supporting player into the main act in the precious metals narrative. With markets bracing for turbulence and the cracks in the global financial system becoming harder to ignore, silver's rise is being interpreted not just as a price event, but as a warning signal. What makes this moment even more consequential is the looming threat of a broad market correction. Equity valuations remain stretched, debt levels are suffocating, and central banks are cornered by the impossible trade-off between fighting inflation and preventing financial collapse. In such an environment, the case for safe haven assets strengthens dramatically. Investors are increasingly drawn to tangible stores of wealth like gold and silver, not only to hedge against volatility, but also to prepare for a potential systemic reset. If the tide does turn sharply in financial markets, the inflows into precious metals could accelerate beyond anything we have seen so far, pushing silver and gold into uncharted territory. How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts on experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.